I know a lot of you have been waiting for, and that's legendary bear Nouriel Roubini. Nouriel, we had a conversation last night over dinner in which you shared some pretty interesting thoughts about what's taking place over in Europe. Clearly, the market is trying to digest what's taking place there. Dow was down 185 at the start today. It's recovered. You've called what's happening there a slow-motion train wreck. Expand on that for our viewers, if you would.
Well, it's a slow-motion train wreck in the sense that the Eurozone is not going to collapse in the next 6 months or 12 months. But Greece is not going to be the only country that has to restructure its debt in a coercive way. I think it's going to happen in Portugal, in Cyprus, most likely in Ireland, and eventually could happen even in Spain and Italy 2 or 3 years down the line. Secondly, I think that by next year, at the latest, Greece is going to exit the Eurozone. That's going to lead to contagion to other weak, distressed members of the Eurozone. And Greece is not going to be the only one who's going to exit the Eurozone. Now, if a small group of countries, Greece, Cyprus, Portugal, restructure and exit, the Eurozone survive. But if down the line the problems, debt, growth, and sustainability spread to Spain and Italy, they lose market access, the bailout doesn't work, they have to restructure the debt, and eventually they might have to exit, that would be a breakup of the Eurozone. It's a slow motion because it might take 3-4 years for happening, but it'll be 3-4 years in which all these tail risks coming from the Eurozone, economic, political, fiscal, financial, are going to get gradually worse.
When you say slow motion, and by the number of countries that you expect to exit the Eurozone, how many countries are we talking about? 2, 3, 4?
Well, as I said, I think Greece is going to happen. Eventually, Portugal and Cyprus will happen. I don't think Ireland is a competitiveness problem. Ireland can remain the Eurozone, but has to restructure.
What about Spain? How worried are you about Spain today when we see what yields are doing, talk about the banks needing to hold on to more capital?
I'm worried about Spain, but as I say, it's going to be slow motion. By the end of the year, Spain is going to lose market access. They're going to require a troika out. It's going to keep them out of the markets for a year or two. That's not going to work out. Maybe 2 years down the line, then you have a coercive restructuring of the debt. That is, with the debt problem, doesn't restore the competitiveness, and eventually even Spain could exit the Eurozone. But it's not something that's going to happen in 12 months. That's why I think of it as being a slow motion process going to unravel over the next few years.
So then what does that mean for not only the U.S. markets, but the U.S. economy?
Certainly there is a risk of contagion. The trade links between Europe and U.S. are modest, but the financial links are important. In the spring of 2010, when there was the first Greek crisis, you had a correction of 20%, not only of European equity, also of U.S. equity. Last summer, when we had the worries about the Eurozone problem spreading to Spain and Italy, it was a 20% correction in Europe. It was almost as much a correction in emerging market in the United States. When trouble occurs in the Eurozone, the risk of something disorderly implies risk is off, risk aversion is high, and that affects global equity markets, not just those in the Eurozone.
But you're not expecting the U.S. economy to get the contagion to fall into a double dip by any stretch. In fact, your prediction to me for what economic growth was going to be for the remainder of the year, I was somewhat surprised by that. You're looking for, I mean, slow, but 2% growth.
Well, I see 2% growth. That is better than Europe, but is well below U.S. potential with unemployment being high. But I worry about next year, because by next year there is a fiscal drag given the fiscal cliff, and wages are not growing in real terms. What has sustained disposable income growth has been taxes and transfers. Some of them are going to expire next year, so you'll have a double whammy, a fiscal drag and another round deleveraging of households. Then if the growth is only 2% and you get this drag, growth could go towards 1%, is back to stall speed, the risk of a double dip. In a situation in which Europe is in trouble, we might have a war with Iran on the issue of the nuclear proliferation. China is slowing down, may eventually have a hard landing. So by next year, you could have a perfect storm.
The funny thing is people listening to our conversation here would think that Roubini must have 100% of his money sitting in cash, when I'm struck by the fact that you told me you have 70% of your money invested in global markets through equities and only 30% in cash, and 50% of your 70 is in the U.S.
Well, the reason is that there has been a global economic recovery for the last 3 years. Economic recovery, financial market recovery, earnings recovery. And as I said, for the rest of the year, I expect that all the policymakers are going to kick the can down the road. In the Eurozone, in the United States, in China, the trouble is going to occur by next year, when we cannot kick the can down the road in the Eurozone, even the U.S. with the fiscal drag, even in China where the political transition requires a change of economic policy. Therefore, timing is important. Right now, I don't see the markets falling sharp. sharply. I see the U.S. stock market being flat for the rest of the year, and therefore I have that position.
Nouriel, thanks so much. Nouriel Roubini today. Lots more from the SALT conference is straight ahead. We'll continue our conversation, of course, with Rick Reeder, where he's finding opportunity.